All right. Well, good day. Hello, everyone. Thank you for joining us for another session where we talk real estate. And I have today my friend Tom Staub, and we're going to talk about a few things relevant to the current times we are in. This is December of 2020. And don't get fooled by, if you can see this and not hearing on the podcast, don't get fooled by the baby face Tom here. This guy is sharp. This guy is very keen. And I have to admit that the first time I spoke to him, I thought, what does he know, or
I
how
know.
much experience he has? And then this guy starts talking, and I'm like, oh my God, so much ideas and creativity and intelligence. And one thing I don't think I ever told you that I always like to talk to people that we have really not just say out of the box, but original thinking. Maybe an out of the box is the wrong term here, in the sense of they look at things a little bit differently, not the common thoughts and ideas and threads you usually hear out there. I try to push myself always to challenge my own thinking and not follow the herd, which I've been seeing for years. People just copy pasting ideas. I think this is wrong, or not wrong, but not always the correct thing. So when Tom and I spoke over the past year or plus several times, I was always impressed by his ideas, his perception of things, very clearly articulate, very clearly thoughtful behind it. And I thought this is a genuine good person to bring on board. Why don't you start a little bit with an intro so people know about your
Yeah.
background, who you are.
Yep.
Please go ahead.
Yeah. So first, thanks, Danny. It's funny you mentioned the baby face, right? Because I started my career in corporate finance and Wall Street and all that madness. And even though I was a hustler and I worked my tail off, like the young face, and I'm not trying to brag here, but the young face, I think, hindered me, because you get in like a boardroom and you're giving recommendations, and they're, to your point, they're like, what does this kid know, right? So for everyone out there, I'm 36 years old. And I have about 12 years of experience in real estate, right? So 08 till 09, 08 till about now. So do I know it all? Absolutely not. Have I made mistakes? Absolutely, in all different ways. And I've done things from single family homes, flips on single families, BRRRR methods on single families. I've bought buildings and flipped them, essentially arbitrage within lending. I've done private lending. I'm now developing land, 75 acres in Arizona. We're doing a subdivision there, as well as a luxury resort for glamping. I own businesses, so I've done all kinds of different things, right? And again, I've learned a lot of what not to do, which I think is more important than knowing what to do, right? And so, Danny and I have definitely done some work together, and thanks again for having me on the show.
Sure, good. Well, I wanted to keep it somewhat simple for today, and I thought that there's two topics I would like to kind of pick your brains and hear what you have to say. The first topic is, we are now December of 2020. We are into this wacky world of COVID with all the implications. And I think there's also a lot of mixed signals out there between real estate is doing well on one hand, but at the same time, we're expecting things to go to crash and maybe not, and interest rate is going down. In the past, let's say less than a year or so, you work with investors. What are you seeing from your end? What are you seeing what people are doing or not doing? Because you actually tackled this. You just said that it's important to know what not to do, not just what to do. When it comes to real estate, what do you think are the common mistakes, or people should have been doing, during the current times, knowing what we know, right? We know so much to a certain degree. We don't know how the economy will unravel in 2021. So what's your take about people's behavior, investors' behavior, wannabe investors' behavior?
Man, what a question, right? It's a big question. And I don't think, honestly, we have enough time to go over what it actually means across the board, but I think I'll hit on some key concepts, right? Or at least what I think. And so the first thing is, I think it's really important to understand this K-shaped recovery. And before COVID, I was saying there's essentially two forming economies, right? The C and D class economy that are renters, work in service industries. They have the $400 in their bank at most for savings. And those are the people that were struggling. They have not seen wage increases, relatively speaking, versus inflation for 30, 40 years, right? So there's always issues there. And the other side of the economy, the A part of the economy, the people that have the tech jobs, they were doing very well. And in fact, they're doing very well now, right? And in fact, if you look at the stats, the people who are buying these homes today, the people who are getting the cheap debt, who are investing in the stock market like gangbusters, are people that are in that top part of the economy. And so they're doing just fine. And you have to look at all your decisions, I think, and the speculation around, okay, well, who's going to be affected? Which markets are going to be affected by the lower end class and the upper end class? And so when I talk to my investors, most of them don't think about that, one. And two, back in 2015, 2016, when I started one of my companies that helped people get into turnkey investing, I had to sell the idea of owning rentals. People didn't understand why they would, I don't want to deal with tenants. Is it really worth the money? How do I know that, it's going to appreciate? Fast forward to today, and you have the likes of Robert Kiyosaki and Ken McElroy talking about buying rentals. There's not enough inventory to supply the investors. So the mindset has shifted so much, and really favoring real estate in a number of ways. On top of that, if you just look at general investing strategy that I have, so I had my friend on, Jonathan. He's a hedge fund manager. He manages over $1 billion in assets, and we got into the details. Back in the day, you could put some money in stocks, put some money in bonds, put some money in gold, whatever, and you would have this essentially pretty stable portfolio. Well, today, every asset's going in the same direction, like aside from Bitcoin. And so there's a lot of risk in the market. And I think people are seeing real estate as a real opportunity to diversify across your portfolio. And so what I tell my clients is real estate, I think, has a great future ahead with the cheap debt. The Fed has promised to hold rates until 2023. So cheap debt's going to be here for a while. And if you can pick the right markets that have a lot of tailwinds, that have some appreciation potential and some cash flow, I think you're in a really good spot.
Let's see. Okay. Were you saying for a second, you mentioned that some investors, it seems like you have a different conversation with investors now versus 2015, 2016, when you started the company. And it sounds like back then, like they were hesitant about investing in the concept of rental properties. And now it's more like, what's different?
Well, now it's everyone wants one. And they're all about it, to a point where they're buying just some terrible properties. And there's also a lot of cash out there. There's a lot of people on the sidelines. In fact, I think I read an article that there's roughly $5 trillion in capital on the sidelines right now. So people they're speculating on this idea of a dip of any asset, whether it be Bitcoin, whether it be Tesla stock, whether it be real estate. And here's the thing is that I think the idea of a dip or substantial dip, especially in real estate, is just not going to happen. I think it will happen in certain markets, parts of Vegas, maybe parts of Florida. I'll tell you, I'm tracking Vegas and Miami every day using the Redfin data charts. And you just don't see the price decreases that you did back in 2008. And I think there's so many people with eyeballs on these deals. They're waiting for a dip. And I think if you're waiting for a dip, I think you're just going to be a sore loser in the end, wishing that you had got in earlier. So
I'm interesting to know about those conversations with investors, because I'm having, I guess, to a certain extent, similar conversations, probably similar profile people to a certain extent, maybe sometimes if the same ones, right? But let's just say, a lot of them, come from with a similar background, and probably every one out of three these days is expressing an interest or a fear or a main concern about values. Like, I've been doing this for such a long time. Every era has its own keywords, right? Like values or appreciation or whatever that is, right? So right now there's a lot of discussion, being asked a lot about the value or the fear of a value decrease. And actually I did a podcast episode yesterday, tackling this concept. Is this something you were hearing, or not very much?
Yeah. So I mean, there's a great consulting firm called John Burns Consulting Firm, and they analyze like the cycles of real estate. So real estate has a cycle like any other market, but the corrections in real estate are just not as drastic as the stocks market. And so, yeah, people are worried about the valuations of real estate, but I mean, let me just give you a few facts, right? There's around 2 million units in shortage of supply right now. Developers on average per year are behind developing by 300,000 to 500,000 units every year. So that's going to keep growing. If this foreclosure crisis happens, and they are going to probably extend the eviction, moratorium here in a few months, which will hurt the landlords, potentially a risk of default for the landlords, that might happen. And it's probably going to happen in the D and C class markets. Even if you assume the worst case scenario and there's 4 million new units, it's still not going to affect the higher class properties, I don't think. And in general, even if you were to balance that, you're only talking a surplus of 6 months of supply. So that's a lot of numbers I just told you. But what that means is that the substantial 30-40% correction fears, even 20%, it's just not going to happen. You might get 10% in certain markets. Again, I think parts of Vegas, anything that
10% reduction.
Yeah. So if it's $100,000 property, $10,000 in reduction, right? Parts of Florida, I mean, but across the board, the nation's, I think, is going to be just fine. And it comes down to a supply and demand issue. You're going to have Biden coming out with this first-time home buyer credit at $15,000, which is double what it was back in, I think, 08 or whatever, 07. So that's going to put pressure on new home loans. The problem is not supply or is not demand. We have plenty of demand on real estate. The problem is supply. You got to incent the developers to develop more affordable housing and everything else. So I have been on many podcasts about this. I just don't see how a major correction is going to happen in the real estate market. So that's my take.
You know that as someone who is a graduate of the 2008 recession, I think the supply challenge really started there. Maybe even before, but what happened during that recession, for the most part, many builders nationwide stopped building. They couldn't compete with the low prices of foreclosures. So that means for a period of 2-3 years, builders, maybe even 4 years. I mean, of course, some did build, and maybe, a small, builder that builds 20 houses a year or 50, that's a small one. They probably continued, but a lot of the big builders stopped. They were getting organized, maybe starting to buy land to be ready. And that kind of a shortage, kind of probably started back then, that they couldn't keep up, and they're maybe for years still trying to keep up with the demand, and the population grew. It's not like the population stayed steady. So
right.
You're absolutely right with it's bottom line. Supply and demand is the most fundamental force in economy, and will dictate those things. And we are, it's funny. I felt that before COVID, there was a lot of shortage or a lot of challenging to find inventory, and now it's even worse.
Yeah.
Okay.
That's crazy.
Now, the other question that I thought would be good to talk about is more trends. And trends it's a big word, but do you see, or are you able to spot or identify, or maybe start seeing some emerging trends of behavior in different sectors or segments, either by population type of segment or by properties type of segments that are starting to emerge, or maybe already showing signs of emerging for several months that you're tracking, or kind of focusing on and trying to want to see how they do in the coming months?
Yeah, absolutely. So, well, there's things that I tell my clients, and there's things that I think are happening behind the scenes. I just put out a video about the commercial real estate crash. Everyone's talking about the residential crash, but the commercial crash is already happening. And it's actually just getting started, I think. And so commercial is going to take an absolute bath through probably April, May, June. Hotels, the CEO of Starwood came out saying that 1/3 of all hotels will be gone after this. You look at small businesses across San Francisco and New York, for example, you're at 40% closure rates. So restaurant, that industry is going to be completely, hammered. You think about, the Black Friday sales down 52% year over year. So all those plazas are going to
I mean,
have
in-store
vacancies.
sale.
Yeah.
In-store,
Yeah.
yeah. Okay.
Yeah. So I think commercial has a ton of headwind. So what's going to happen? I think you're going to see people like BlackRock, Sequoia Capital, these big names come out and buy these properties and repurpose them into mixed use, into affordable housing. So I think that's going to be a big thing. Now, obviously, that's for the bigger players, the bigger investors. I think being a developer myself now, I think the trend that I see is going to be build to rent. Keep in mind, most developers are only making 20 to 30% margins on their development, right? So and there's a massive shortage of contractors, about 20%. We don't fund those skills for education. No one's going to school to be a plumber anymore or electrician. So the cost of their wages is skyrocketing. Timber is going up in price. So the margins for developers are being contracted. So they're coming up with new models on how to make money long term. And so just recently, the housing permits report came out in a very low manner, which is bad. Like, again, more supply shortage. They're refocusing their efforts to find the margin, and those margins are just in different products. So I think a lot of opportunity is going to be in the commercial space, which I know your listeners might not have the capital to do or the know-how, which is totally okay. But there's going to be opportunities to be in syndications that are repurposing the commercial spots or part of these build to rent opportunities for sure.
Good. Are you seeing any type of trends of moving out of the major cities to suburbs?
Oh yeah.
Moving from multifamilies to single family or vice versa?
Both. Yeah, those are great points. I think if you look at any population report, people want affordability across the board. It's interesting. Everyone that on my Instagram now is talking about no income tax. Like, people that have no business talking about tax at all are like, oh, I'm moving to Texas or Florida, no income tax. So the secret's out. People know that they can get an instant 10% boost on their income by moving to Texas or Florida or Nevada or Washington State. And so they're moving, right? And a lot of tech companies are not changing the wages. Some are and some are not. And so you're definitely seeing, for those that can afford it, again, the upper economy, they're getting the hell out of New York and Chicago and San Francisco and LA, and they're moving to the more affordable areas with better climates. So that for sure is happening. And then I think when you see the issues with rent collections, my portfolio is now all single family rentals. And I sold my last building last year, actually. So the rent collection issue is hitting the multifamily areas a lot more than the single families. So the single families are doing just fine. People want single family homes. And so I've received no problems with any of my rentals, cross my fingers. So that's what I'm seeing in the trends as well.
You're saying single family rent collection. I would probably assume you're in the mid, let's say lower middle class, something type of areas. Probably not the lower class.
No, I'm buying properties that are $120,000 to $200,000.
I see.
That's
a middle class segment, pretty much in most areas around the country. And that's usually people that are able to keep their job even from a distance, which is not always the case with the lower class, working class.
That's right. That's right. Yeah.
Okay. It's interesting. I had a conversation with one of my investors yesterday. He works. He's a manager, team leader in Microsoft for many years. And he's been with Microsoft up there, for a very long time. He said, he has a exemption. He wants to go and work from the office and not stay at home because it's, less comfortable for him. But he says, I go to the office. I have an entire building by myself.
Mm-hmm.
And he says, Microsoft, if I understand correctly, if I remember correctly, he's saying Microsoft already told everyone they can probably work remotely at least until the end of 2023.
Oh, wow.
2023. Now, I could be wrong about maybe misheard him or something, but that's what I heard. And then, I think what you're seeing in a lot of tech companies, a lot of companies altogether, but not just tech, maybe tech is kind of leading the world, the change. People obviously are moving to, you just said let's move to Texas and get in a way, a 10% increase in our income. But actually, it could be more. It's a 10% increase in my income just because, you know, I pay less taxes. It's also maybe a 10% drop in my cost because I live in the cost of living, let's say in, I don't know, Dallas
it's way
is
cheaper.
lower,
Cheaper. You know, I drive a fancy sports car, so I get the high-end gas, whatever. And my gas is like $2 a gallon for like the premium gas.
Yeah.
Right.
Yeah.
I mean, in California, it's like $4.50, right?
Exactly.
It's crazy.
Yeah. So that's what I mean. And I think more and more people will start moving, already starting to move to other areas and working remotely. And then he actually said, you know, I might as well even think about moving to a different country, which I want to live in.
Yeah.
And work from there. But the biggest challenge is that, and that's interesting, that the international taxation is going to have a challenge. Are you employee of the U.S.? Are you employee of another country? You know, so it's kind of but that if remotely will stay,
Well, let me just. I mean, again, I don't know everything about remote work, but I do know something about general business. And when there is a glowing problem in the market, that's an opportunity. So people will see it as a problem. Others will see it as an opportunity to create something. So I hear a lot about, well, the Zoom culture doesn't create collaboration for now. You don't think someone's going to come out with some way to create more collaborative ways?
100%.
So give it a couple of years. You'll see a startup in the same format. So
I think there's going to be an opportunity. There is an opportunity there because when the working remotely, you lose the informal communication, the bonding aspect of it, but something will come in and close that void for sure. Someone will find some sort of a tool or mechanism, or I mean, it's kind of probably putting some the pieces of the puzzles together.
That's right.
So tell me, where are you putting your efforts these days again? What you're kind of mainly focusing on your end?
Yeah, so I have this philosophy, and this is my own thing, that 80% of my income comes from stable, channels, right? So that's private money lending. I have some consulting businesses, rentals, and whatnot. And then I believe that the rest of your income should come from these home run projects. So every year I have one home run project. Last year it was a commercial building that I flipped. This year it's land up development. So we are developing 75 acres just outside of the Grand Canyon, west of Flagstaff. It's going really well. We're going to break ground here. 75 acres. Yeah.
Oh, a tiny piece of land.
Yeah. It's crazy. Not to brag, but I've rented a big old truck. I went down there to my land, and I was going through the land, and I've not even seen all of it yet. Because there's all these trees, these like nice like desert pine trees. So I don't even know what's on my land. I did discover a guy living on my land in an RV that I had to kick out because he's so far back in there that like who would have ever have found him. So, but we are now developing. We break ground early January on the excavating. So that's been a great learning experience, and I'll probably keep doing the land up development for some time. And we're also developing a glamping resort has some pretty big upside there. So beyond that, I'm looking for deals always in the single family homes segment. There's always a deal out there somewhere, but I'm being more choosy for that. Living in Austin and just, enjoying life.
Good. Excellent. Well, Tom, always a pleasure. I'm glad we had a chance to finally get it done. And I appreciate your insights and thoughts and ideas and concepts. Always enjoying speaking to you, fellow colleague, but I would say original thinker. Yeah. So thanks very much for joining. And thank you everyone for listening. As always, we try to make sure we bring you valuable content and information so you can actually ideally benefit and use it to your own personal investment. You're always welcome to get in touch with me, have a strategy session, talk about your needs, your challenges. Everybody has challenges. Everybody has concerns and questions. I only, I've been doing it only for 17, 18 years and more than 4,500, rental transactions, probably close to about 100 flips. So I've been around the block, at least one recession behind me, probably going through some sort of a craziness right now.
You have some wounds.
Yeah. So thank you, everyone. Thank you, Tom. Have a terrific rest of your day. Have a terrific weekend. And of course, stay safe.